Welcome to the CBR Briefing, your concise, clear-eyed snapshot of what matters most in Caribbean business, economics, and public policy. I'm Joseph Cox. Across the Caribbean, the rising cost of property insurance is colliding with outdated valuations, climate risk, and structural vulnerabilities, leaving thousands of homeowners underprotected and overburdened. In Jamaica alone, the Insurance Association has revealed that while only 20% of residential properties are insured, a staggering 95% of them are underinsured. This is a silent crisis spreading across the Bahamas, Dominica, Guyana, and beyond. For many families, insurance premiums now rival or exceed mortgage payments, especially in hurricane-prone areas or for homes built using traditional methods such as wood or concrete nog. Why is this happening? Let's unpack the drivers of this affordability gap and what we can do about it to restore insurance as a meaningful safety net. First, we have outdated valuations. Most insured homes are covered at values that haven't been updated in 5 to 10 years. Co-insurance clauses trigger harsh penalties if replacement costs exceed insured values. For example, if your home is worth twice what your policy says, your payout could be cut in half, and the valuations aren't free. They typically cost 0.25 to 0.30% of the home's market value. These add significant recurring financial burdens, especially where valuations are mandated every 3 to 5 years for mortgage renewals. Second, construction type matters, and most people are unaware that there are construction type penalties. Indeed, older or hybrid constructions attract premium loading or additional surcharges of up to 100%. For example, wood frame homes may incur a 30 to 60% surcharge, concrete nog homes 15 to 25%, and wetland daub 75 to 100% relative to base premium rates for block and steel homes. These surcharges significantly increase annual insurance costs for lower income households and owners of older structures and are simply unaffordable. Third, premiums are surging, especially in high-risk zones. In places like the Bahamas and Dominica, insurance can exceed 2% of your insured value every year. That's $5,000 annually on a $250,000 home or over $400 a month. In some cases, monthly insurance payments have been observed to exceed monthly mortgage obligations. Fourth, insurers often apply distinct premium surcharges for hurricane, earthquake, flood, and fire risk. These increases may be embedded in the base premium or listed separately as endorsements. For example, hurricane coverage alone can account for 60 to 80% of a property's total annual premium in coastal zones. Flood risk, often excluded unless you request it and pay for it specifically. Fifth, there's a growing imbalance between mortgage and insurance costs. Especially for long-term loans or smaller homes, monthly insurance payments now match or exceed mortgage installments. This imbalance introduces affordability risks and contributes to underinsurance or coverage lapses. And sixth, rising reinsurance premiums are making it worse. Global reinsurers have raised premiums significantly due to escalating payouts from US-based climate disasters. Caribbean insurers reliant on reinsurance markets pass these costs on to homeowners regardless of whether the regional losses have occurred. This imported risk burden raises the baseline cost of property insurance for Caribbean homeowners even in the absence of local disaster events. This imported risk is raising baseline costs for everyone. In addition, there is a lack of transparency and knowledge. Few Caribbean jurisdictions offer centralized valuation registries or automated valuation models. Many homeowners don't understand how premiums are calculated or how to determine true replacement costs, and even fewer understand the average clause, a policy condition that proportionately reduces insurance payouts when properties are underinsured. For example, if a property is insured for only 60% of its replacement value, any claim, even partial, may be reduced by 40%. It's a penalty on top of a loss. However, it is important to note that the high cost of property insurance is not just a homeowner problem. Landlords typically pass these costs on to tenants through higher rents. In tight housing markets, especially in urban centers or tourism zones, rising insurance premiums are a contributing factor to rent inflation. This extends the affordability crisis to non-homeowners, compounding socioeconomic vulnerability. So what can we do? We propose 5 core strategies. Update valuations across the region. So in other words, promote affordable tech-enabled revaluation over 3 to 5 years. 2, introduce tiered premium structures with discounts tied to resilient construction and retrofitting. 3, launch microinsurance models for low-income and traditionally built homes. 4, invest in digital tools and public education. And 5, strengthen subsidies and risk pooling. So in other words, it could expand the CRIF linked risk transfer solutions and national insurance support schemes. Property insurance is no longer just about risk. It is now a determinant of financial survival and resilience in the face of climate-driven catastrophe. As home values rise and disaster risk intensifies, insurance systems must evolve to ensure Caribbean households are protected, not penalized. The affordability trap created by high valuation fees, structural surcharges, hazard-based endorsements, imported reinsurance costs, and punitive clauses like the average clause is now a region-wide vulnerability. Without bold reform, we risk leaving both homeowners and renters exposed.